right. These are just some issues for different other types of tax sales. So sales of block stock, mutual fund capital gain distributions, and sales of shares for mutual funds. First off, does everybody know what a mutual fund is? No? Okay. So a mutual fund it's a type of investment vehicle where it is managed by a financial professional, and what they do is they buy stock from a variety of different companies and they put it into the mutual fund. And so then the mutual fund itself sells shares of the mutual fund. So it's a collection of different businesses within that you can buy shares in. So so for example, and they have different, like there can be industry specific types of mutual funds. So like a technology mutual fund might hold Apple and Microsoft and Tesla and, a variety of different technology focused shares, but it combines it into one. So what that does is it spreads out the risk, right? So when you own shares in a mutual fund, you indirectly own shares in all of the companies that the mutual fund invests in. So there are thousands of different mutual funds, and every single brokerage out there has their own mutual funds, and they are actively managed. And the thing about mutual funds is they usually have fees that go along with them that reduce the returns on those mutual funds, but they, because they're actively managed, ideally, by professionals, ideally, then they will generate, maybe better returns than if you were just to pick your own stocks here and there. People will invest in mutual funds as well as individual stocks. So just because you're investing in a mutual fund doesn't mean that you can't also invest in other types of securities. It's different from what they call exchange traded funds, ETFs. ETFs are another type of investment where it's a collection of different companies that are owned by it, but the ETF is not actively managed. So there's more, there's just more management with the mutual funds than there are with the ETFs. So these are just different types of investments, different types of securities that people can invest in. A lot of 401k retirement plans or retirement plans that are sponsored by employers, a lot of them, the only thing they offer is mutual funds. So you get a menu of mutual funds that you can choose from to invest in. Some of them are very conservative. So like they just invest in treasuries or things that are really, they're not going to give you a high rate of return, but you're also not going to lose money on them, except for the fees that you have to pay. Others are riskier. So if they're investing in areas that are, have more volatility. So you have potential for higher return, but you also have potential for losses in those. Some mutual funds as well will focus on different geographic areas. So if you're interested in investing in in Europe, so there are mutual funds that invest in companies that are in that geographic area. So there's all different types. There are socially conscious mutual funds, so that invest in companies that if you have like a certain environmental, if you're really into environmental issues and you want to just invest in companies that are focused on the environment and focused on like net zero and stuff like that, there's a mutual fund for you. So anyway, it's a conglomeration. It's a package of different companies' shares. Well, what happens in these mutual funds is that because they're actively managed, they are buying and selling different shares all the time. Maybe they decide that they think that Microsoft's not, they could do better with buying Tesla rather than Microsoft. And so they sell their shares of Microsoft or some of the shares of Microsoft, and they buy shares of Tesla? Well, because it's trading all the time within this mutual fund, there are capital gains and losses happening all the time, right? Because anytime you buy or sell a stock, you're going to have probably a capital gain or a capital loss. Well, all of those capital gains are combined, and when you own shares of a mutual fund, you have to pay tax on your share of the capital gains within that mutual fund. Those are called capital gain distributions. So it's not something that the shareholder has to, or the investor has to keep track of. It's something that the brokerage keeps track of, what those capital gains are. Those are called capital gain distributions, and they are taxed at long-term capital gains tax rates. And investors will receive at the end of the year a 1099 that itemizes how much they received in capital gain distributions. Now, they may not have actually received any cash from that, because what happened was they took it and they reinvested it in other shares of other companies. So those capital gains distributions don't have any relation to the amount of cash that the investor received. What they say is this is the portion of the capital gains from this entire mutual fund that the investor, what they're responsible for, what their ownership in those capital gain distributions are. So they are, if it's capital gain distributions, they are reported. I'm going to go past this 4797. I don't know why it's here. See if we've got a Schedule D here somewhere. Maybe. No. Well, this is an example of maybe a 1099-B. They usually don't look like this, though. They usually have a lot. They're like full page, and they've got a lot more lines than this, a lot more information. But this at least shows you. So where are the capital gain distributions? They don't even have the, maybe it's on another page. No, that's dividends and distributions. Oh, so it's on the 1099 DIV. So it shows under like dividends. So here, total capital gain distributions, that's where that would be listed. But where that ends up getting entered, here we go, Schedule D. They're all, even if they're short-term, they're treated as long-term. Okay, so even if it was a short-term transaction when it happened within the mutual fund, it gets treated as a long-term when it's reported by the taxpayer. So it goes on line 13 of the Schedule D right here. So it'll get combined with the other long-term capital gains, and it'll get combined with all of the other, it'll get incorporated into that netting process. Okay, so that's capital gain distributions. Another thing I want to mention in this section, let's see here. So sometimes people will, you don't usually just buy stock once and just walk away, right? Most times investors will buy multiple blocks of stock. So they will buy, let's say I bought, let's say it's Apple. Well, let's say it's Microsoft, because I kind of know what the price is of Microsoft. So I bought some Microsoft December 2020, and its price on that date was $100 a share, and I bought 10 shares. So my basis in this purchase was $1,000. But then I decided I was going to buy some more Microsoft. It's gone up in price, and I'm really happy with it. So I bought some more in December 2021. And the price at the time was $200 a share. So I bought 10 more. So my basis in that lot is $2,000. And then I bought some more. We'll make this easy, 20, 22, and it was $300 a share. So I bought 10 more. So now my basis is $3,000. So my total basis here is $6,000. Now, I decide I'm going to sell some of my shares. I'm going to sell 15 shares. So I did that 12/24, and the price at the time was $500 a share. So I sold 15. So my proceeds were, was it 5,000, 7,500? I got 7,500, but I had 30 shares. I sold 15 of them, so I still have 15 shares. I have to figure out what my gain is on those, right? Which shares did I sell? There are 3 different ways that you can do this. The first is you can use first in, first out. So the first batch is what you sold. So I would have sold 10 of these. My basis is 1,000 in those. And then I sold 5 of these, and my basis would have been 1,000. So my basis would be $2,000. And I would have a gain of 5,500 because I got 7,500. My basis was 2,000. That's first in, first out. Another thing that I can do is use what's called specific identification. I can decide, okay, I really don't want to pay that much tax right now. So what I'm going to do is instead of it was 10 from that first batch, I sold the 10 from the last batch. So this is 3,000. So now my basis is $4,000. Now I have a $3,500 gain. I've just saved taxes, right? Because now I'm going to pay tax on $3,500 instead of $5,500. I still have 15 shares. My remaining basis is going to be 5 from here, $1,000, $2,000. So at some point when I sell it in the future, I'm probably going to have an even bigger gain, provided Microsoft still goes up in value. The third way of doing this, and this is the way that mutual funds will do it, because they'll report any, like if you sell in the mutual fund, they'll give you the basis and they'll do the calculation for you. The third way of doing this is an average, is a weighted average. So we have 6,000 shares. I'm sorry, $6,000 total basis. You total up the whole basis, divide it by the total number of shares. We have an average basis of $20 a share. I sold 15 shares, so $3,000 is my basis in that scenario. That's my weighted average. So I'm going to total up the total basis. I'm going to divide it by the total shares that I have to get a per share basis, and then I'll multiply that by the number of shares that I sold. So in this case, I have a $4,500 gain. Okay, 3 different ways of doing that. First in, first out, specific identification, and weighted average. Okay. That's for block shares. What else do I want to say here? I think this is just, so here's 3 different scenarios. First in, first out, specific identification, and then average basis. Worthless securities, sometimes you buy something and it ends up that it goes to 0. So in that case, you do get a capital loss that you can claim, but it has to be declared worthless. So the definition of worthless is what's important. Worthless securities will follow the capital loss limitation rules for deductibility. So again, you're still limited to $3,000 to offset other income. If the security becomes worthless during the year, the taxpayer will report a loss on as of the last day of the taxable year. The fact that a company declares bankruptcy is not sufficient to indicate that it's worthless, because sometimes bankruptcy, they're just reorganizing, right? So sometimes it's difficult exactly to pinpoint when that worthless status happens. But like if it's a publicly traded company and it's owned through a brokerage, they'll let you know if it's worthless. So there's a 1099-B. It's an example. You got to have information on how many shares were sold. So this would be received when somebody sells a capital asset from a brokerage account. Remember that question on the 8949 about was it reported on a 1099-B? Was the IRS notified? Well, so here you got the date acquired, date sold, how much was received, cost or other basis. Now this one, this is a really bad example because they actually don't have it on here. Normally it would have a checkbox on if it was reported to the IRS. But the fact that they don't have a cost or basis reported here means it wasn't reported to the IRS. So that's what the box that would be checked there. Those capital gain distributions, like I said, show up on the 1099 DIV statement in box 2A. So those are our ordinary dividends, qualified dividends, all that stuff. And again, the capital gain distributions show up here on line 13 of the Schedule D. That's, again, there's the 8949. There is a capital gain, qualified dividend, capital gain tax worksheet that can be used. I don't think you need to use it, but oops. Okay. Let's see. So sales of inherited property, again, it's the fair market value is whatever the fair market value is at the date of death. And it's always going to be long-term. If it's received as a gift, the fair market value is whatever the basis for the inherited property is the value on the date of death, and it's always going to be long-term. If it was received as a gift, recall that you're going to just adopt the donor's basis and the donor's holding period. So if it was long-term to the donor, it's long-term to you, it's short-term, and all that. All right, and then they've got this, I don't know if it's helpful or not, they've got this chart, I never really found this helpful, of the different types of assets. So our capital assets, ordinary assets, what they are, capital assets, what they are, 1231 assets, and then we've got these subsets of those assets, the 1245, which is personal property, that subject to depreciation, 1250 assets, real property, and all that. And there you go.